Welcome. The global lithium market has just weathered a severe downturn, a period that served as a significant stress test for the entire industry. For Ganfeng Lithium, however, this volatility wasn't just a challenge to be survived, it was a validation of its core strategy. Today, we're going to dissect how the company's vertically integrated model provided a unique defense, allowing it to navigate the cycle effectively.
And so, let's begin with our primary conclusion. The 2025 downturn acted as the definitive test for Ganfeng's business model, and the key takeaway is this. The vertically integrated structure proved its strategic value. It functioned as a powerful hedge, demonstrating clear resilience and, importantly, positioning the company for the next phase of the market cycle.
Our analysis is structured around 4 key pillars. We'll start with the external environment, the turning point in the lithium market. Then we'll move inside the company to analyze how its integrated model functions as a strategic hedge. From there, we'll examine the downstream battery business as a critical growth engine. And finally, we'll assess solid-state technology as a tangible future catalyst.
So first, let's establish the macroeconomic context. The lithium market itself appears to have reached an inflection point. After a very difficult period, we're observing signs that point away from a simple cyclical bottom and toward a more structural recovery.
The market appears to have established a price floor right around 60,000 yuan per ton. Now, why is that number so important? It's not arbitrary. It represents the approximate cost support level for marginal producers. At prices below this, significant supply becomes uneconomical, which in turn creates a natural support for the price itself.
But what's really significant here is that the market isn't just hovering at this floor. It's actively moving toward a new equilibrium. And this new balance point seems to be fundamentally anchored to the marginal cost of production needed to satisfy future demand. You can see that trajectory taking shape here. From that floor of 60,000, prices have already recovered towards 75,000. And market consensus suggests a new equilibrium is likely to form in the 80 to 90,000 yuan range, a level that more accurately reflects the industry's underlying production economics. So, what's driving this recovery? Well, the demand structure has undergone a critical evolution. If you look back at the 2021-2022 cycle, it was almost exclusively driven by electric vehicles. Today, the demand base is far more robust and multifaceted, with energy storage systems emerging as a second and very powerful growth driver. And the scale of this new driver is substantial. We're looking at projected growth of over 50% in global energy storage installations for this year alone. This is absolutely critical because it diversifies the demand profile for lithium, reducing the market's sole dependency on the automotive sector. Okay, with that market recovery providing the backdrop, let's now pivot and focus on Ganfeng's internal strategy. The central question is, how is the company's model designed to both defend against these cyclical downturns and capitalize on the subsequent recovery? The answer is found in its integrated value chain. Ganfeng's structure provides control across the entire lithium life cycle. This starts upstream with its own resources, moves through midstream processing of lithium salts, and extends all the way downstream to battery manufacturing. In the first half of 2025, this end-to-end control proved to be a decisive strategic advantage. The data from the first half of the year tells a very clear story. You can see a significant divergence in performance. While the upstream lithium chemical business saw its margins compressed to 8.4% amid falling prices, the downstream battery business actually expanded its revenue and maintained a much healthier gross margin of over 14%. And the battery segment is not a minor part of the business. Its scale is what makes this divergence so impactful. It now contributes over a third of the company's total revenue. This means its counter-cyclical performance provides a substantial buffer for the consolidated entity. This dynamic creates what is effectively a powerful natural hedge. The very thing that pressures the upstream business, falling lithium prices, becomes a direct benefit to the downstream battery division through lower input costs. It's this internal synergy that was instrumental in maintaining positive operating cash flow for the company as a whole, even during a sharp industry-wide downturn. Looking forward, the strategy is to reinforce this integrated model. You see key upstream assets like Goulamina and Mariana currently ramping up production. The objective here is to increase the company's self-sufficiency in raw materials. This isn't just about pursuing growth, it's about building a structurally lower cost base, which in turn should enhance margin stability and resilience through future cycles. So, the model has been tested and has performed. But what comes next?
For a complete assessment, we now need to balance the forward-looking opportunities, particularly in technology, against the key operational and market risks that lie ahead.
A primary catalyst on the horizon is the advancement in solid-state battery technology. And what's changed is that management has now attached specific, commercial-grade metrics and, crucially, a tangible timeline for mass production. This effectively shifts the narrative from a long-term R&D concept to a near-term catalyst with a defined product launch. Of course, this outlook must be balanced against a clear set of risks. We see these falling into three main categories. First, there are macro market risks. A global slowdown could certainly impact demand for both EVs and energy storage. Second, specific geopolitical risks tied to assets in Mexico and Mali. And third, there's the execution risk inherent in managing the simultaneous ramp-up of several large international projects. So to conclude, Ganfeng's performance through the recent downturn offers a compelling case study on the value of vertical integration in a cyclical industry. The model clearly provides a shield against commodity price shocks. This, however, brings us to the central question for the future. As the global landscape shifts, how will this same integrated model adapt to a new set of challenges, ones driven less by price volatility and more by the fundamental reconfiguration of global supply chains?